I think we get started. Since we're recording this, we could always send it out to anybody that did not make it. So welcome to Tuesday, 7 p.m. Eastern Time. Today we're going to have our good friend Brandon Brookman go over DSTs on this Tuesday night webinar. He's going to talk about pretty much keeping more of what you have, of what you make, and legal way to defer taxes. He'll roll into different topics of discussion, and then maybe a cherry on the top with 1031 discussions. Brandon, I don't want to steal any of your thunder, so please go ahead and take it away.
Yeah, absolutely. And thank you guys for, allowing me to present to your group and to your investors. I really appreciate it. We had as backstory for everyone, we had a very interesting conversation a couple weeks ago, I believe, about these areas and avenues. And honestly, I thought you guys are extremely proactive in thinking about, hey, we recognize our investors have this issue. Like, what's the best way for us to solve it? And to really dig in on these issues and figure out, hey, what should we do? Like, how do we help folks? So I got a few slides. So I will share my screen and walk you guys through those. And let me know when you can see it. Can you guys see my screen?
Yes.
Yep.
Let's go full screen present. Let's get really wild. Can you guys see that full screen?
Yep, full screen.
All right, cool. So yeah, we're gonna do the 101 on DSTs. And here's the disclaimer. Quickly read it. Go. Yes, I showed it. We won't get in trouble. So really quick, before we get to the meat of it, who am I and why am I talking about this? I work and help start a firm called Insight Investment Advisors. Insight was, founded about 6-7 years ago, based out of Kansas City. My partner Josh Wright lives there. As you can see behind me, I'm in Milwaukee, Wisconsin. And we sort of collaborated on starting this shop. Our background is not in real estate. It's more in the investment side. I worked at a hedge fund for a long time. And that's sort of the way that we sort of looked at the world. Josh approached me probably about 4 years ago and said, hey, I think there's something here with 1031 exchanges and helping people really get passive. And I'm like, what's a 1031 exchange? I have no idea what you're talking about. What is this real estate stuff? So his dad had this problem as well. So his dad had 9 hotels in Kansas and went through a series of medical issues and had a desire to sell and said, all right, let's do it. And they walked to their CPA, went through the whole process and said, oh, wait, you have a 40% tax bill. Threw it at Josh and said, go fix this. So at the time, there really wasn't an option for that. And so today we'll talk about, an option that would have been really helpful. So we went on this mission to figure this out. So that's me, and my family. There's me with a beard. I don't know which one's better, beard or no beard. I'll let you guys figure that out. But like I said, in terms of background, hedge fund, I've started a couple different consultant companies. I did the data thing for a long time at Fortune 500 companies. So a lot of different experiences. And I think it helps out a ton in what we're trying to do here. So let's hop right into, what is this Delaware Statutory Trust thing? Very kind of confusing for a lot of people on what the hell I'm talking about. So let's start with why do investors want to do DST? What's the desire? And there's really, when it comes down to it, we see 3 different need cases for this product. Number one, we refer to as the retiring real estate investor. So think about somebody who's self-managed property for 20, 30 years. They're just ready to be done doing that for whatever reason. Health, as I mentioned earlier, just a desire to do something else with their time in life. They've built up a pretty nice nest egg. They've built up quite a few doors. They're ready to be done. And so if there isn't a family that are ready to take this stuff over, what do you do if you want to sell today and not wait till, unfortunately, you die? Like, what's your choices? You don't have many. So the DST is really created for that base case of performing a 1031 exchange, deferring tax, and being passive. And we'll discuss that. 2 other cases that we see relatively often, but not as much, is when you have boot in an exchange. And I'll explain what that means as well. The boot that you'll find are left, or say you find a great property, you want to buy something direct, but it's not quite enough, or not quite as much as your proceeds from your last sale. DST could be an option. And then finally, as a backup plan, as everyone knows, the biggest complaint, if you look on the internet for 2 minutes about 1031 exchanges, is the timeline. It's very tight. And it could leave you in a situation I've heard multiple times of people saying, couldn't find anything, had to pay the tax. So DST can play as a backup plan. So, all right, let's get down to it. What is a DST? And the very simplest way to describe what a Delaware Statutory Trust is, or DST, is it's fractional ownership of real estate. That's basically it. It's very similar to, as an investor, from an investor perspective, it's very similar as being a limited partner inside of a real estate deal. You would feel the exact same way you feel in a syndication, you'd feel in a DST. The biggest difference being, in the eyes of the IRS, this is eligible for an exchange. You can use this, and in their eyes, it's like you own the property, be it a fraction of it, but the tax treatment and the way the IRS looks at it is like you own this property. So, big distinction there. As I'm sure the folks listening on this call know, you can't be a limited partner and do a 1031 exchange. Unfortunately, that's a partnership. As the IRS, that isn't property that you own. Granted, the partnership owns property. So you go explain that to the IRS why that makes sense. It doesn't to me, but anyways, it is the rules. And so the DST is designed to be that asset that can truly be passive and can provide you that 1031 exchange eligibility. So its simplest level is fractional ownership. And the assets we see here really range in a variety of different assets, mostly multifamily we see in our space, but now really a tilt toward industrial self-storage. You can stick any type of asset class into a DST. You can put that structure around it. It's not an issue. As I said before, who are these designed for? Mainly that retiring real estate investor. So DSTs are going to have certain characteristics of the type of assets in them. Most of these are stabilized, and the vast majority are providing cash flow in day one. What you won't see in a DST is a lot of value add properties. Now, why is that? There's a couple reasons. One, the DST is a closed-ended structure, which means I can't make a capital call. So let's say, like something actually goes wrong in a syndication, which never happens, right? And you need to call capital from your investors. Cannot do that in a DST. It's a closed-ended structure. On top of that, you can't refinance either. So a big key tenet of, I think, GPLP syndication is that ability to refinance. And the possibility of doing that has always been a really great thing to return capital to investors as quickly as possible. Not possible in the DST infrastructure. So you can't do that there. So what we'll see is, naturally, this is going to be much more of a conservative play in doing the DST versus the GPLP syndication. Point three, this is an area for accredited investors only. That is very similar to, I think, syndications as well. I think it's the same thing you sort of see as well, that you really have to be accredited to participate here. What we also see is very experienced sponsors in this space. And with sponsor, I'll describe what these people are on the next slide, but a sponsor is very similar to a syndicator. They're the people who are going to set up and structure these deals. So the most beautiful thing about this space and the way these deals are structured is there is a track record of every one of these sponsors closed and open deals inside of every offering document that you find. Now, granted, it's on page 250 of that PPM, but it's there. And it's something that you can readily read and understand how these folks have performed. So it's easy for you to start to do comparisons on, hey, how good is this company? It's easy to understand that. And we do have experienced sponsors in this space. Final point on this slide, exchange and basis step up. So this is what's kind of cool about this is, of course, I mentioned you can use this in a 1031. But again, in the eyes of the IRS, this is like you own property. So what's really nice is if you don't have a very clean succession plan, you can really step up your basis here as well. This asset, once you pass, you can step up your basis. And if you have your house in order in terms of an estate plan, you can pass these assets on to your children, right? As opposed to some of the situations that I've seen where, the children aren't interested in the assets, and they're forced to do, frankly, a lot of work when you leave this planet and leave Earth. They're forced to do a lot of work to sell that property. It's not the case here. The DST will continue to run. Once that DST full cycles, children can do what they'd like with that cash, but there is really nothing for them to do, even upon you passing. The beauty is you still get that step up in basis. So really a vehicle designed for folks, frankly, most of our clients are over the age of 65. They're in a later stage of life. It's a wealth protecting mechanism is what I feel like that we're doing in order to save them some time. I do see something in the chat. So let me click on that real quick. Oh, please ask any questions. Yes, please ask any questions. I would like to have them. Who are the players in the DST? So I mentioned this before of how this is sort of structured. So really let's call it 3.5 key players here. The sponsor, as I mentioned before, these are the folks that are responsible for setting up the structure. They identify the property, they place it into the DST, they formulate everything around it. So there's a lot of legal work that goes on here to make sure the structure is accurate and valid. We have seen deals in the past that violate key tenets and rules of DST. So it's very, very important that you have somebody like us to kind of review some of this stuff. The trustee, which is often the same as the sponsor, really oversees all the ongoing aspects of that trust. So they're watching compliance of the DST rules. They're actually going to hold that property. They do have some limited fiduciary duties. They have to do what's in the best interest of that trust. And the beneficiaries. Beneficiaries are you. Those are the investors. Those are the folks that we hold interest in the trust, a percentage of that interest. We receive a share of income and profits from the sale. Key point I want to mention here about how folks get paid here. Inside the DST structure, we can't have that GPLP promote. It's not allowed. So that cash flow is going to investors, virtually all of it. The master tenant has to have some economics there, so they'll keep a little sliver there, but the vast majority of cash flow is headed right to investors. So completely different, I think, fee structure than I think a lot of syndicated investors are used to. The fees are more fixed. They're more laden at the front of the investment, and they just don't occur throughout the deal. So a little big difference there in the way that's sort of laid out. And then ultimately, there's, of course, depending on the asset, there is an asset manager. Usually the sponsor or the trustee is hiring that person or team to sort of do that work. And they're the ones that are responsible for the day-to-day operations. So there's somebody that we expect the sponsor to manage. There's somebody we expect reporting on, and we do see that at least quarterly from folks to understand how those folks are performing and how they're doing.
Hey, Brandon, since you're touching on the sponsors right now, can you go over like the type of documents you expect from the sponsor before you allow anybody to kind of be part of that program?
Yeah, I think there's two sort of key things that we'll do with the sponsor. One is doing deep due diligence on them. So understanding, we'll do background checks on their leadership team. We really want to understand their track record. Fortunately for us in our space, there are 3 firms that also do third-party due diligence as well. They'll produce reporting on sponsors too. So it's almost like a double layer of due diligence on the sponsor level. On a deal level, in terms of the documents that they're providing, it is a very detailed due diligence sort of folder that they're giving to us. So PPM first and foremost, but we also see the appraisal, rent rolls, insurance, property assessment reports, environmentals. There is a detailed amount of information that we're receiving, often vastly larger than what we get and look at in a syndication deal. And the reason for that is that the sponsors will pre-acquire this property. They'll already hold it. They've already completed the transaction. So they're able to have that information available for us. They're waiting for us as investors to come into that deal, which is great from a due diligence perspective, one, but also, as I'll talk about in the slide deck, is awesome from the 1031 timeline perspective. We're eliminating a lot of timeline risk because I got $1 billion in equity we need to raise for DSTs like tomorrow, right? So if you're doing a 1031 exchange today, there's deals readily waiting for you to invest in immediately. So we're kind of eliminating that backside risk as well. But to answer your question, it's a lot of detailed information that we're gaining about these deals, and we're really able to dig in pretty deep.
All right. And also the risk perspective of the deal not possibly closing as opposed to a deal that's already been squared away and ready to get buttoned up.
Yeah, it's a huge difference. I mean, and you guys can probably share some stories from your side. It's a wrangling activity to kind of walk through a lot of what's going on and to get this thing closed. And it's already been done. It's been done from their side. Either the sponsors are big enough they're using their own balance sheet, or they are using some form of, and this is less likely now, but some form of bridge debt to get
Mhm.
to the point where the investors will eventually take that out of the equation. Okay, so how do we DST? So a question that I get a lot is, oh, cool, I'll do a DST instead of a 1031. No, no, no. The DST is the replacement property in the 1031 exchange. So we still got to go through that process. So you do have to sell your property. You have to set up a 1031 exchange, and we're using the DST as that replacement property. So that's a very crucial aspect for investors to think about. Is you absolutely have to not take the proceeds of the sale of your property. Otherwise, we got a huge problem. I really can't help you at that point in terms of investing in DST. You can't complete an exchange if you do that. I get one call maybe every other month now. It's declining, but I get probably one call every other month where folks are like, "Hey, I'm ready to do a DST. I got a check in my hands." Uh-oh. No, you're not, unfortunately. And I got to be the one to deliver the bad news. So don't call me and let me do that to you. It's really bad and never fun. So we still do have to do that process. And then, as I mentioned, sponsors are waiting for you with the DST, which is great. So very often we have no issues of not only identifying inside the 45 days, there's absolutely no reason we can't close inside of 45 days. And we'd eliminate the need to even fill out an ID form. So we're not even thinking about 180 in a lot of these cases. It's just it's a non-factor. So we get to kind of take that off the table, which is pretty cool.
So essentially, you're operating as a custodian, as a self-directed IRA in a sense where the investor cannot touch any of that capital. It just has to get rolled straight to Insight.
That's not us. So the way that process works is I never actually touch the money at all. So a qualified intermediary, another third party will. I can't do that as someone's investment advisor. It has to be an unrelated party, has to really have control of that money. So that's usually somebody associated with your title company, or it could be another third party who will work with your title company and will hold those funds on your behalf. But yes, yeah, someone has to play custodian there because remember in the way this rule was set up 100 plus years ago now was it was set up as an exchange. So the IRS's mind is still not sell and then buy. They're still thinking exchange. And so they do not want to see you holding those proceeds. So your
Mhm.
closing statement on your property will say to qualified intermediary on behalf of Jeff Rodriguez, right? It'll say that on there. So your name isn't on the closing statement as receiving the proceeds. It's going to that third party. Now, obviously, you have control over that account, but that QI is acting as sort of a custodian or holding
Mhm.
in a holding capacity to make sure we complete the 1031 exchange.
All right.
But we'll never see it. So then the next step from there is if we're identifying DST and going down that route, we'll you can identify as many as you want on the DST side, but that money then will be wired from the QI directly into that trust. So it bypasses Insight. I never see it or touch funds ever. What do we actually do then? If we're not touching the money, like what's our job? So we'll quarterback the 1031 process. I still see 3 out of 7, I'll say, closing statements with expenses on that closing statement that are not 1031 permissible, right? And they create boot. I still see it. I see it all the time. And so we'll
Can
want
you,
to,
can you provide
yeah,
examples of those kind of expenses that you're referring to?
yeah, like prorated rents is one that I see all the time. If that's on a closing statement, that's boot, unfortunately. The only expenses that you can have in a 1031 exchange are really related to the sale of that property, i.e., sales commissions to a broker. You're going to pay the qualified intermediary a fee to hold your money. Things of that nature associated with the transaction can be on the closing statement. If they're not, that's boot. And that's okay. So that really it does create a little bit of tax there. Let's say a couple $1,000s in prorated rent that you would have to maybe pay and have taxes associated with that. So it's not a big deal, But at the same time, sometimes I find some really interesting stuff. For example, I was really digging into a loan payoff associated with a 1031 exchange, and we found a pretty hefty prepayment associated with that loan. That is boot. So what we did was identify that for our client and said, hey, you have to bring in cash. You can bring in cash to your qualified intermediary to sort of supplement that. You can do that. So that's a way to sort of solve that problem. So we'll have some investors and clients will do that. They'll bring cash to the qualified intermediary to sort of cover those expenses. Others will say, it's a couple $1,000s in boot, no problem. We'll just pay that in tax. It's a small tax bill, obviously, not an issue. But it's something to be really aware of when we're going through the exchange that I don't think you hear a lot from title companies. And unfortunately, a lot of the closing statements I just get, right? Like the transaction's over and it just kind of drops on my desk and be like, wait, this is not this expense, this expense, this expense, that's boot. So what do you want to kind of do about that? So I think it's still important for us to kind of play this, we kind of say quarterback the
Mhm.
exchange because we're not necessarily involved or don't need to be involved, but we do find things. But really, the last 2 points is really where we add value and we have to. We build these portfolios for folks. We're looking to meet people's cash flow needs, and really, there is debt requirements in that exchange as well that folks need to sort of think about and making sure they're executing those exchanges properly. And maybe I'll go through the 1031 rules a little bit so folks have some context around that.
Yeah, absolutely.
Um, but we're watching for those things too. And then ultimately it's doing due diligence, right? And really kind of digging through this and figuring out what's good and what's bad. If you type in, you can do a Google search, Delaware Statutory Trust or DST horror stories. They're out there. They're out there. It's just like any other real estate deal. Are there bad real estate deals in the marketplace that you don't want to buy? Of course there is. Is there stuff that you would not own that's listed on a broker website today? Of course there is. There's no different in the DST. There's deals in DST land that I wouldn't touch with a 10-foot pole. Just
Well,
wouldn't.
is it because there's people out there that don't know the rules and all the requirements needed in order to do a proper DST, or is it, you know, trying to do some shady stuff and wiggle some stuff out there? Is that what's usually the cause of that?
Um, a lot of the deals we reject are based on the real estate and the economics associated with it.
Mhm.
So, for example, I still see a lot of multifamily, Class A type things bought at sub five cap rates, right? So if we start doing the math on that, like that doesn't really pencil, right? If we get, if we get continue in this rate environment, it's gonna be very difficult for folks to make money in those deals. So
Mhm.
that's what we'll see more of. Is just sort of bad deals or deals that just don't pencil. We'll
Mhm.
see more of that. Occasionally, yeah, we do reject things because the construct of the DST is not in line with it's violating some of they call them the seven deadly sins of DST. It's violating some of those sins, or it's dancing on a line that we really don't want to be involved in. The last thing in the world that I want is the IRS to come back and do
Mhm.
an audit of that structure and disallow an exchange for one of our clients. I mean, that's a 30-40% hit,
Mhm.
and that's no good. We can't have that. So occasionally we'll reject for those reasons, but it's more of like, just don't like the deal. I don't know what to say. Like it just doesn't pencil out. Like I don't understand the thesis, or it just doesn't make a lot of sense to kind of do that deal. That's what we see more often than not.
Okay.
We're very picky, so there's probably about I don't know, maybe 40 or so, 35 or so DST is active in the market right now. We're showing our clients about seven. So we're just picky people in that sort of way about what's out there in the marketplace. We'll do 10, want to do 1031 exchanges quick?
Let's do
Let's
it.
do them quick. So we have some context of that. Super high level. So I won't dig in too deep, but I won't skip a slide either. As I mentioned before, you absolutely have to have this qualified intermediary. Ask your broker, ask your title company, hey, do you do 1031 exchange services? Just ask, and they'll answer you, and they'll hook you up, and you'll be fine. The timeline is the one that really gives people the heebie-jeebies, right? 45 days to ID, 180 to close. Ouch, right? It hurts. And so we hear a lot of things, and This just, it hurts when I hear this. Oh, that's a good deal for a 1031 exchange investor. What in the heck is a 1031 exchange investor? There's no such thing, right? There's people in 1031 exchanges, but we're all investors, right?
Mhm.
So don't let the tax sort of tail wag the deal dog and start buying three cap Chick-fil-A's. Sorry, that's a bad idea, right? So I'd rather have you pay the tax than do a bad deal. But the real thing you got to do here is you really have to plan. I mean, that's the secret. And unfortunately, what you have to do at the same time is worry about selling your property and worry about the replacement property. You got to do these in conjunction with one another. If you start looking for replacement property on day one of your exchange, you might want to call me if you really don't want to pay the tax because we got to have a backup plan. It's just too
Mhm.
hard.
Yeah, we had an investor situation like that, and it turned out that they were better off just paying the taxes versus rolling into a deal. So it's not for everyone, it's not for every single deal, but it's an option, it's a tool to have in your back pocket for planning.
100%. And I really encourage people to, one of the first questions that I ask folks that come to our desk is, hey, have you talked to your CPA? Have you had a conversation with them about what's your actual tax bill? We had one client who did not do that and was really closing an operating business along with the real estate and left a lot of active losses on the table that could have been used to offset the capital gains. And he could have walked away with a little more cash in hand to do what he wanted to do with it and not exchange. So it's really critical to have this conversation with your CPA up front to understand, hey, what is the tax bill? Do I have other offsets? Am I comfortable with the bill as it is? Then don't do this process, right? But to
Mhm.
not have that conversation is a very bad idea. So please start there when you're looking to sell and understand what those gains are. I think I kind of hit this. Really have a plan. You got to do both at the same time. And I get a lot of questions all the time finally about, what can I exchange into? Can I exchange a multifamily to self-storage? The answer is yes. Can you sell a farm and buy an industrial building? Yes. Can you go the other way? Yes. Almost all real estate, investment real estate is what's referred to as like kind. All of it's the
Mhm.
same. And so you can trade into sort of whatever you want to. It's kind of fun. Mention the timeline. Time is not on your side. And there are no exceptions here either. So I hear a lot of those questions too. Can I get an extension? No, this is not your taxes. Timeline is the timeline. IDing rules. So at that 45-day mark, your qualified intermediary is going to ask you, hey, need you to put something on a form. What do you have to put on that form? You need an address. Not, hey, I might buy something in Milwaukee. No, you need an actual address of the real property or of a DST, right? And we need to follow one of these three rules. Rule number one that everyone follows mostly is the three property rule. One, two, three addresses. You close on a number of them that you want to. So we see most often. The
Mhm.
DST is we're using a lot of 200% rule. Because in a few of the DSTs we have, they hold 8, 9, 10, 12 different properties. Kind of cool for diversification, but it does require us to use this rule. 200% rule says you can identify as many properties as you want, up to 200% of the fair market value of what you sold. So that opens the door to kind of whatever. We can put 100 properties on there if we really wanted to. You can do that with the 200% rule, provided that you hit that. The most stringent rule that most people never use is the 95% rule. This is if you want to go over that 200% fair market value, but you better be darn sure what you're going to acquire because you have to close on 95% of what you identified without an exception. All right, so we rarely see that one. We will see, like I said, most of the time we see three property, but 200% is useful. If you do intend to ID more than three properties, you can do that. Your QI, a good qualified intermediary or QI, will walk you step by step through those processes and to help you to do that and do it properly. What else can I tell you? That's really 1031 exchange, and that's really DST. So I hope that's helpful. I think the use case, it's very important to understand the use case for DST. 1031 exchange, not excited about paying the tax, really want to be passive. DST fits really well. If you're looking to continue, where does DST not work? Doesn't work if you're like, hey, I really want to go tackle 20% IRR deals and do ground up construction. This is not for you. Hey, I really don't care about year one cash flow. Probably not for you. It's probably not going to be a good fit. No, I want to go after more aggressive deals. Go ahead. So like key takeaways here, really talk to your CPA and understand what that tax is. Make sure you're operationally setting up 1031 exchange properly, and then consider if this is sort of a fit for you. If you're sort of thinking about those items that I mentioned, cash flow is important. I hate paying tax just like anyone else. I want to use the tax code as much as possible. So for me, it makes a lot of sense to think about, how can I do that? So that makes sense. But I'll answer any questions if folks have interest and want to reach out. I'll walk through every single deal if they really want to, front to back, so they can understand it.
Yeah. So there's a question about what is structurally different in a DST versus a 506C?
Not sure I know what a 506C is, to be honest.
It's
Referring to.
pretty much it could be a fund, it could be a syndication for
Oh,
accredited investors.
sure, gotcha. So a big difference from a fund. A fund, again, it really is the 1031 exchange component. So a fund and a syndication, not 1031 exchange eligible. So if I have a property, I'm selling them in a 1031. I'm like, I really want to invest in this deal. If I'm a limited partner, you want a partnership in the eyes of the IRS, not real estate. So that's the biggest difference. And from the fund perspective, same sort of parameters as the syndication. And then additionally, on the fund side, there is some ability for fund managers to change the asset composition of that fund really whenever they wanted to. That is not the case in DST. There's addresses, you know what you own, you're going to own it for the life of this investment until it's sold. And so there's certainty in knowing what I have and the ability to do due diligence on that. In a fund structure, we don't have that because there's ability to change those assets. Can't do that here.
What is what is the timeline for somebody to from start to finish to get set up to do or transfer, do a DST or a 1031 setup?
I would say there's more. They're going to spend. We zoom back to sort of this slide. They're going to spend. You see my pointer on there? I want the red pointer. I can't find it. That's okay. They're going to spend more time doing selling their property and doing and setting up the 1031 exchange. This is going to take vast amounts of more time than if they engage with us and they want to move quickly. There's absolutely no reason I can't walk someone through the complete process and close them inside of a week. Like actually wire funds inside. There's no reason we can't do that, right? If we want to move fast. Typically, it's more like two week, 3 week process because we're spending a lot. This is a lot of like once we start digging in on deals, it becomes a ton of information. It's a lot for people to absorb up front who haven't sort of played this game before. So that takes more time than not. But there's absolutely no reason that we can't do, spots 2, 3, and 4 on this slide. We can't do that in a week. No reason we can't.
Right. Okay. Is there a beneficiary option when doing this type of transaction?
Say that again.
A beneficiary.
Oh, absolutely. Yeah. I encourage, yeah, we have to think about a lot of like end of life planning items, considering the average age of our investors.
Mhm.
So I really encourage folks to establish a trust, and to establish that entity, be it an LLC or still see a lot of individual named properties coming to this space as well. Let's get that stuff in a revocable trust and really handle the beneficiary type instructions and information through that trust and have this just be an asset inside that trust. I mean, that's what I do with the majority of my passive investments are aligned inside of our trust. So I'm not worried about that beneficiary option. If folks don't want to do that, yeah, absolutely. You can absolutely have beneficiaries aligned with the sponsor. They'll take that information from you and help you work through that. Sponsors are very helpful in changing entities and helpful in a lot of those end of life situations. Are very helpful in sort of helping you navigate that.
And I got one more question. When it comes to fees, what can one expect to see? Is it based on the amount of capital that's being transferred, or is it just based off of work?
Yeah, it's a standard percentage that you'll see on every deal. The fees are the ones that really that really give people heartburn. We've been able to, we're a registered investment advisor. And why does that matter? So that's helpful in reducing some of the upfront sales commission costs associated with these products. And so that's taking 6 to 7% we see as a sales commission up front. We are able to eliminate that from the equation. That's really helpful. However, we still see acquisition fees up front, usually between 2 and 3%. We see cost to set up the legal structure for these items. We see reserves. You'll often see reserves held in these deals because you can't make a capital call. So
Mhm.
that's hurtful. It's not a fee per se. You would get reserves back, but it is a drag on your return set throughout the investment. So really three sets. You have that upfront kind of acquisition cost, management fees in the middle, which you'll usually see net of cash flow anyways. So those range from 1 to 2%, and then sponsors will take a disposition fee as well. So if they made money on the deal, they're taking 1 to 2% on the backside as well. So it's a different fee. It's more of, it feels more like more of a fixed fee structure instead of sort of the promote or profit sharing that we see in syndication.
Mhm.
So there is a lot of similarities, I think, in the overlay of cost structure between the two items. They're just laid out differently.
Right. Okay. If I don't see any more questions, however,
I have a question actually. Hey Brandon, are you familiar with the concept of a lazy 1031?
Yeah, absolutely. And I think that concept works. And I think it works well for folks that want to continue to be active and and sort of work through it that way. There is a lot to be said for resetting your basis and assets. So like one of the problems that we have with folks transitioning to DST is that basis is continuing to decrease in their asset. That depreciation schedule when you 1031 exchange comes with you. So if you've held assets for 20, 30 years, basis is going away. What does that mean? That means the cash flow coming off of these assets becomes very taxable, right? I'm not getting those same benefits that I get from investing in real estate. So there's a couple different ways for us to sort of work that out, and try to do something to offset that income. A lot of it involves, frankly, investing in more assets, oil and gas deals, real estate, etc., to produce some losses on paper so we can offset that tax. So to your point, though, the lazy 1031, if folks continue to want to be active, it's a very viable strategy to sort of talk through to reset the basis on the asset, and take advantage of these bonus depreciation laws that we have right now that have to go away unless they get reenacted. Now is a great time to take advantage of that. So yeah, we encourage folks that want to do that economically. I think it makes a lot of sense. I think we see folks not do that come to my desk. It becomes more of a lifestyle decision for them than an economic one, in that they just want to be done. They really want the passivity, right? And so they kind of want to aim at that more so than the economics. But I think the lazy 1031 is a very viable strategy.
Yeah, I heard that about that strategy actually for people who are limited partners in syndications would get exit of a deal to go into another deal. So you achieve more or less similar results than 1031. So that's
It's a
because
very tricky thing that investors want to work through with their CPA, because a lot of the investors we see come to our desk are active real estate investors going to passive. So that doesn't work because their CPA would look at it and go, wait, active gains, right? Passive losses. And those don't mix, right? So they'd have a big problem with it. If it's passive to passive, you could make that work.
Okay.
Right? Or active to active, you can make that work, right? Like that's my point of why I was saying that if they want to continue to be active, if you still have that status as a real estate professional and you're an active investor, yeah, I think you want to explore that in more detail. But when you start crossing those two lines, it becomes difficult.
Right. Understood. Yep. Yeah. That makes sense. Thank you.
Yeah. Awesome question.
So one last question. Anything that's coming down the pipeline as far as like SEC regulations or any type of regulations in regards to DST that's going to make changes, kind of like taking away the 100%, bonus depreciation type of stuff?
Yeah. Nothing related to DST in particular. There are sort of three things that popped in my head that a couple I'm excited about, one I'm not excited about. So I think the changing of the accredited investor rules is amazing. It's amazing for us, probably for you guys, for everyone involved to democratize this. And I've like stood on my large soapbox and screamed this with no one listening. The accredited investor rules are silly. They make no sense. We need different rules here for folks. So I think that is going to open up our marketplace a little bit, and help people participate or act in this that they couldn't before. I've turned down multiple potential investors for not being perfectly accredited before, but definitely had the need. So I'll be excited not to do that anymore. So that's coming. I'm excited about, we didn't talk about opportunity zones or get into it. We do parlay in that area as well. I am excited if we extend that deadline. 2026 is a deadline that you have to pay your tax in that sort of arena that may get extended to 2029. That would be really exciting. I think there's been a lot of good, bad, and ugly in the OZ program that has gone on. But if we can emphasize the good, I think there's a lot of good to be done there. So I'd love to see you get an extension there. That bipartisan legislation is active in Congress now, so we're excited about that. And then the question I get a lot is 1031 going away? Well, no. Is it threatened every 7 years or so? Yes. Has there been huge modification to this? Yes. So equipment before, and these are Trump tax cut changes, not Biden. Equipment used to be 1031 exchange eligible inside your business, not anymore. So it's only been narrowed down to real estate. That's been a big change relatively recently to the laws, which makes it kind of scary. It seems like there isn't the support to eliminate 1031 exchange. So cross your fingers that that's still going to be around. We do have, I believe 2 years ago we hit the 100-year 1031 exchange anniversary. So happy anniversary to 1031 exchange. That's
Congratulations.
yeah, right.
Yeah.
Let's keep it. But it's always something we kind of have our eye on. And if that gets more serious, it'll be time for us to think about other solutions. So we'll figure something out. The tax code is humongous, and very little of it is about paying taxes. A lot of it is about not paying taxes. So we'll find some solutions, but that's always a threat that we're thinking about.
Absolutely. Awesome. A lot of gold, a lot of information right there, a lot of tools to add to everybody's tool belt. Yeah, so if you can pull up the slide where people can get in contact with you, if they have questions, follow up with you.
Yeah, while you do that, I just wanted to mention, because you mentioned the new rules for accredited investors, and I think you refer to the upcoming test that will be available in a few months, which absolutely will open a lot of opportunities out there. It will be much easier for people to access all opportunities.
And I wonder what's going to be on the test.
What's that?
I wonder what's going to be on the test.
Oh, yeah. Who knows? I mean, FINRA's taking lead apparently on that. So.
Oh, never mind. Now I know what's on the test.
So we'll see. At least they have a lot of testing areas throughout the country. So that's the logistics that's figured out already. But as that information comes out, we'll send it out and keep our investors informed as well on those changes, because we know we come across a lot of investors that unfortunately are not accredited, but they have the inclination and the capital to invest, except they just don't fit within that little scope of information that they say this is what it requires to be accredited. So hopefully that changes. It opens, like you said, opens up the doors, make it more fair across the board, and allows people to be more diversified in other assets besides just stocks and bonds. So thanks.
From an advisor perspective, we support it. So the stock and bond guy, which we do work in as well, we're highly supportive of giving people access to whatever they can get their hands on to diversify their portfolio. They should have access to it.
Absolutely. All right, Brandon. Well, thank you so much. Thank you for taking the time, everybody. Thank you for taking your Tuesday out and visiting us and sitting on this webinar. Hope you got some information. If you have any questions, feel free to reach out to Brandon. If you have any questions for myself and Philippe, you have our information. Until next time, we'll see you guys on our next webinar. Thank you, and we'll see you again.
Thanks, everybody.
Thank you.
Bye-bye.